Good afternoon and welcome to the Netwealth webinar today. Today the webinar is called How to Find and Invest in ASX Growth Companies, and we have Tim Samway with us here. Before we get started, we'll just run through a little bit of housekeeping. We'll send the slides to you after the webinar. If you have any questions during the course of the presentation, you can enter them into the chat on the right-hand side of your screen, and we'll get to as many as we can at the end. If you're posting to social, can you please use the hash NetwealthInvest or tweet at NetwealthInvest. So I'd like to introduce to you Tim Samway, Managing Director at Hyperion Asset Management. Tim has been at Hyperion for the last 20 years and working in the financial markets for the last 30 years. He cut his teeth with a company called Sydney private client broking firm called Burrows, and he originally trained as a chartered accountant. So I'll hand you over to Tim.
Thank you very much. And my goodness, wasn't that a young picture of me? I think it's about time I updated that picture. That's what I looked like when I was a young man. Thank you for joining us today, and I'm going to talk you through buying growth stocks, and I'm going to do it in this six-step process. So I'm going to talk about the current low growth environment and what we can expect over the next 5 to 10 years. Where will the growth come from? So it's a question on everybody's mind with low general returns from lots of asset classes. Where will that growth come from? How do we identify a good growth stock, a good quality growth stock? Some pitfalls to avoid and some portfolio stock insights, because really I think one of the things that's great about a webinar is you can actually have a chat about some of the stocks. And lastly, a Q&A, and by all means put some questions through. We've got plenty of time. I understand we've got an hour, which is quite a long time to go through here. Believe you me, I could talk about this for 6 hours, but we're going to keep it to 1 today. So the first chart here, so it's a little busy, but I think I can explain what this is all about. So growth is and will be scarce is what I've put here, and the top part of that chart is a chart of the MSCI, which is the sort of a world accumulation index of equities, and the blue line is the S&P ASX 300 accumulation index. And I've started it back around the time of the GFC. And the point I want to make here is that in spite of the fact that we've had a reasonable period in recent times in terms of market increases, essentially the last 10 years has been a bit of a forgotten decade. It's been a bit of a wasted decade, and in fact the earnings of the Australian market have not exceeded the earnings that they were earning and they were achieving back before the GFC. So it's been a pretty disappointing 10 years, and that would be no shock to you if you've been an investor over that period. It's been very hard to find investments that have done well over that period. I've put down there a couple of other charts which actually are a little pessimistic. One is GDP real growth for the USA, and that shows a gently declining number over the last couple of years, and retail sales, which also is incredibly close to zero in terms of its growth. That's actually pretty disappointing, and in spite of the fact that everybody wishes it were better and everybody's constantly looking for green shoots, the reality is that we think that the next 5 to 10 years in real growth of earnings in companies will be pretty muted and will be scarce. Now, it's hardly a surprise because underlying growth that drives economies really is the outcome of demographics. And so also no shock to most investors who've got enough money to put into the market is that they're usually older than the rest. That might not include everybody in this webinar, but I suspect that the majority of you are in the older demographic. And the reality is that as the baby boomers retire, there's a couple of ratios that are changing in the Australian economy, but also worldwide. And one of them on the left is this old age dependency ratio, and that's essentially the ratio of people who are working to the people who are not working. And so if you think about that, the people who aren't working are the people who've retired and the people who are children. And then there's this number in the middle that are all the workers. And unfortunately, we haven't been producing enough babies in recent years to keep up with the number of people retiring. So the number of people becoming dependent in our economy and in Western economies generally is becoming higher. And that actually puts a brake on economic growth, because the real thing that drives economies deep down is the number of workers. And if you've got less workers, you're just producing less output. And of course, the output is what drives the growth in an economy. On the right-hand side, because demographics are set, we actually know what they look like now. Any change that's made in the birth rate tomorrow takes really 20 years before any of those children ever come into the workforce. So we can look 10 to 20 years ahead and look at the effect of demographics on gross domestic product, or the growth in economies. And unfortunately, the news isn't particularly good. So you can see there on the right-hand side, there is a graph, and it lines up GDP against what is essentially a demographic model, expenditure weighted. So it actually looks out at the expenditure of a number of cohorts of different ages, and it works out exactly what that has in effect for GDP. And of course, what it shows is that with the old age dependency ratio increasing, less numbers of people in the workforce, that things look pretty flat for a period of time. Now, this is not excluding what governments can do to stimulate, and there's a whole range of other factors outside of the demographics. But at the end of the day, it's like the tide. It's the thing that pushes in each direction, and it's pretty hard to swim against the tide. So underlying all of this is, the next 10 to 20 years is looking like a very low growth period. So I've put a chart here. This is a chart that we use a lot in our business. It's the chart of our portfolio, which is a growth portfolio. And what it shows, rather than, it does show outperformance, but I'm not going to focus on that. The green line, the green dotted line, is the earnings per share of our portfolio over time, the growth in that metric. And the black line is the price of the portfolio. And so the thing that jumps out at you when you're looking at this chart is that earnings and price are not very correlated in the short term. So you can see periods around 08 and 09 and even through to 2011 where prices varied quite considerably from the underlying earnings. But if you look over the very longest period, so this goes back to our point of inception back in October 96 when we started managing money, the correlation between earnings and price over the very long term is easily demonstrated. You don't need a formula to know that correlation is strong. You can see it with your own eyes. And that's really what I want to talk about today, is quality growth businesses that you could buy, that you could hold for very long periods of time, so that you could extract that price increase that comes from getting earnings that increase over long periods of time. I've also put on that chart the equivalent number for the ASX 300, the S&P ASX 300. So the blue line is the earnings of the index and the red line is the price of the index. And as I pointed out earlier, the thing that will jump out at you is that the blue line, which is the earnings of the ASX 300, hasn't approached and passed again the height of the earnings in 07, just before the GFC. So it's been a pretty disappointing run in earnings for the portfolio. That is, for watchers who sit there and look at each earnings season in February and in August, it's always quite disheartening to see the market predicting sort of 10% earnings growth across the board and then actually delivering somewhere between -5 and +5. And that seems to be going on. It hasn't changed. This earnings season was only lifted substantially by the miners, which managed to achieve 241% earnings per share growth in the last 6 months. And that's largely on a kick up in commodity prices, but they've got to hang in there for those prices have got to actually not only hold but actually increase for that to keep the prices up. So yeah, I think you can see that gap can be actually quite strong over time. So the gap between either the green and the blue line, which is the earnings, or the black and the red line, which is the price, that gives you an idea over time that if you get the earnings right of a quality growth company, it can make a substantial difference to your portfolio over the long period of time. So where can the growth come from? Well, there are two ways in our mind that you can look at a growth company. Some growth companies take a market like Australia and they increase the size of their market share. So in growing the slice of the pie, we've called it here. That is, become a fabulous competitor in a limited market and slowly put your competitors to the sword, build your market share and therefore build your profits. And while that's a terrific way of doing it, that's been the Australian way of doing things for growth companies, because what happens is they get to a point where they eat most of the pie and the only thing that they can do from that point is actually look at the size of the addressable market. And for many businesses, the only way they've been able to do that is offshore and go to a larger addressable market. And some of them have done it with varying degrees of success. And so I'm going to have a look at some of those today. I'm going to have a look at this whole idea of addressable market to give you a feeling for some of the things you should be looking at, so give you some signposts for things you should be looking at if you're looking to buy a growth company, because you don't want a business that can only grow the slice of the pie, because there's a point at which that business will no longer be a growth business if it's just all it's done is eaten as much pie as it possibly can. What you need are businesses that can grow the addressable market and the whole size of the pie quite substantially. So what I did is I looked back over the last 20 years at some stocks that have been considered growth stocks. That is, if you asked your average market participant what is an example of a growth stock, at times they would have mentioned these three stocks. Bellamy's obviously more recently, and I'll give you a quick rundown on each of these businesses in a second. But you know, these three businesses would have come up as names. So QBE in insurance, CSR in building materials in Australia and New Zealand, and Bellamy's, which is a producer of milk products and the like, powdered milk products. So let's ask the question. Of course, I can't get the answer, so I'm sort of talking to myself here. But on occasions, I've asked people which of these is a growth stock, and you know, there's been a lot of argument over whether it's A, B, or C. And what I'm going to do is now take you through each of these stocks, and we'll have a bit of a chat about which one is actually the growth stock. So let's first go to QBE. So this is a business that grew very strongly from 2000 to 2010. It did it by acquisition, so it bought things along the way rather than grew its business organically. And one of the things that we've found over 20 years of investing is that businesses that grow by acquisition introduce a level of risk to the future of their business. So what happens is often in the early stages they buy something, it looks cheap, but the challenges are integration, cultural integration, business integration, systems integration. That is, often in businesses that they buy, there are a lot of systems that, legacy systems that don't work together. And it's quite challenging managing a much larger integrated business than a simple business. So business models don't often look the same after you've bought and put several businesses together. And QBE is a classic example of a business that's in a commodity, so a commodity type industry. That is, insurance is essentially a commodity. It's very hard to distinguish one line of insurance from another line of insurance. And what QBE has struggled with is, and you can see that from the chart there, which is the price chart, is that after many years of strong growth from acquisition, their organic growth has not come through. So they've been unable to do anything but grow effectively their size of the pie, their slice of the pie. And what they can't do now is increase the size of the addressable market, because they're actually working in a commodity type industry where they're constrained by perfectly good competitors who spend their days getting their pricing accurate and their volumes. And so what you can see now is that for a while this business was doing really well, and the return on equity, so for every unit of equity in the business, they were getting a pretty good return. So there was a point there where it had got as high as 20%. In fact, it had gone over 20. And now in the last 10 years, it's been in sort of low single digits. So for every unit of equity, the return has been in single digits. And look, there's a point that you'd ask yourself, why would you invest in a business that was returning such a low amount of money, given that you can get a safe return in single digits by investing in term deposit. Obviously it's low single digits, but the point is it's risk-free in terms of from year to year. So also I've put some other charts here. This is from our this is our fact set system that we use to pull up information, and it shows sales growth. You can see that sales growth is actually going backwards, and that's the death knell of a business. Is for a growth business to effectively be going backwards or sideways for years on year, because that could be saying to you, without even doing any further research on that, you could be looking at that and saying, well, if they're going backwards and someone else's, and let's assume that the whole size of the pie hasn't changed, then somebody else is actually stealing market share from them, and they're actually growing their pie where this business is not. CSR is a name well known to most investors. It's been around for a very long period of time, and it's grown its revenue at double digits over the past 3 years. So, you know, it had a period there where it grew strongly and the price came off, and then over the recent period since 2013, it's actually grown revenue at double digits. It's been a cyclical upturn in the Australian building industry. They're, unlike Boral, they're just exposed to the Australian market, and building picked up, and as a result, they've really done well. But one of the things that you've got to look at when you're looking at a growth stock is whether it's just cyclical, and so you've got to look behind the growth and understand what's actually driving that growth, and whether it's something that can persist for long periods of time, or whether it's just something that will just run with the cycle. Because one of the things, if you look at a long-term chart of CSR, and so I've been looking at CSR for perhaps 20 years, is there's a stock that's just been up and down with the building cycle for years. And so your ability to make money out of them, a company like CSR, is not like that earlier chart that I showed you, which correlates price with long-term earnings growth. It's more buy low, sell high, and that's great if you can do that, but that's a pretty challenging job for most people to manage, and best left to professionals. And certainly at Hyperion, it's not something we do, because we find it very, very difficult to time the market in and out. It requires a lot of attention, and it takes your focus away from the fundamental long-term money-making ability of companies, and gets you focused on the short-term sentiment in the market. That is the market anticipating a rise in this, whatever that part of the cycle is, or a fall, and as a result trading on that basis. Bellamy's is a more recent one, and you know, by the way, I'm not saying any of these businesses are bad. I'm just saying they're not growth stocks created equally. So, for example, Bellamy's grew very strongly over a very short period of time, and so the real question is whether this business is going to be sustainable. So, you know, similar businesses selling into China, businesses like Blackmores, and Blackmores selling vitamins into China. So Blackmores has been around 80 years. And has built up perhaps the leading brand, you could say, in the world. I mean, Australia has the reputation worldwide as the premier producer of vitamins. It's a much more controlled process here in Australia. in America, you can start a vitamin business in your backyard and start selling them the next day without any controls at all. Here in Australia, there's much more regulation, and so Australia has a deserved reputation for producing high-quality vitamins. The Chinese love vitamins, and they're looking for brands that they can trust, having had their own scandals over the years where, if you'll remember, they found melamine in the powdered milk. So the Chinese are very focused on holistic health, and clearly Bellamy's has a very interesting product for them. But the reality is, it hasn't been able to go through the test of time yet. And that's one of the things that we look for very carefully when we're looking for a growth stock, is a track record of being able to do things over a long period of time. That is, does this business model really cover all environments? And clearly in China, there is substantial regulation to be worked through to get products successfully on the shelves there. And so what we're saying is, does this have the staying power? And at the moment, clearly the jury's out. So, you know, we'd obviously like to see a company like this where it controlled and actually manufactured itself. Unfortunately, Bellamy's is not a manufacturer. They're really a marketing business that's taking product, packaging it up, and having somebody else package it up, in fact, and then market it through to China. And so it doesn't have that same sort of long-term track record of actually controlling product, controlling the marketing right through to completion. So let's have a look at actually how we identify growth stocks. We've got a 20-year track record of producing good returns on quality growth companies. So our outperformance over the market has been about 4.5% per annum since we started. And the way we do that is we start with some screening filters. And so one of the things that you really got to, and by the way, these aren't hard numbers to get, but they are key numbers to get. And so the three that we use to start our screening to get 2,000 companies in Australia down to less than 40 that we actually look at hard is return on equity, historical sales growth, and interest cover. So I'm going to explain those in a little bit more detail. The first one, return on equity, I did cover it earlier. It is essentially the return on each unit of equity that the company maintains. And why that is important is return on equity is a terrific marker for a business that has a competitive advantage. That is, a high return on equity is a terrific marker for a business that has a terrific competitive advantage. That is, if you've got a competitive advantage of some sort, that is that you might be the lowest cost producer, or you might have a very strong brand, or you might have a monopoly, or you might have a very high quality product, or and little competition because there are barriers to entry getting into that market for whatever reason, then often your return on the equity will be higher because you're essentially earning super profits because of those benefits. And we're looking for those businesses because that return on equity is a scarce product in the market. A huge proportion of the companies in the Australian market don't even return double-digit return on equity. They're just getting single digits. And I keep saying, we go back and look at what you can return. At the moment, it's not that great, but over the years, over the long term, you could get somewhere between 5 and 7% on a government bond. And that was essentially risk-free. And why would you take that return on a company in terms of return on equity for all the risk that equity, owning a share has in it? The second point there is we look at historical sales growth. So we've said here greater than nominal gross domestic product over 3 to 5 years. I mean, the reason we say that is we want companies that are on average doing better than the rest of the economy. But it's more than that. We're looking for that track record, a 5-year track record of being able to do things. It's why we wouldn't buy a Bellamy's. We actually want to see a business that can grow over long periods of time, and so it isn't necessarily cyclical either. we like businesses that actually have a long-term, what we call a structural tailwind. That is, something has changed in the economy that actually makes, that puts a wind behind that, the sales of that company for a long period of time. And in the next section here, I'm actually going to explain what that means by going through some examples. And lastly, interest cover. So interest cover is the amount of coverage that profit has over the interest payments. This is important for a key factor, and that is that businesses often get into trouble when they're over-geared, over-borrowed. So what we want are businesses that can produce high return on equity without having done it by borrowing large amounts of money. Because as we've found over many, many years now, is that while borrowings don't look scary on the surface, sometimes what happens is it's actually at the board level when companies are trying to make really good decisions about following a path and looking at the returns on a particular project, the bank is sitting there saying, we won't lend you money on that. And so while there's the risky side of interest, and that is like if you're too highly leveraged or geared and something goes wrong, then the banks take over. So that's at the bad end, you know, that's at the low quality end, businesses that operate at a level where they've got so much gearing that when things go wrong, the interest cover is not covered by profits, they start making losses, the bank's covenants are breached and the bank moves in, and then of course all the equity holders lose all their money once that happens in liquidation. But even at the other end, which is just the limitation of taking really good opportunities because the bank's sitting there saying, no, you're too highly geared, we won't lend you any more money, you will breach your covenants. And that's the hidden side because you don't really see that. That happens behind closed doors. And so these three primary screening filters are used to turn, say, 2,000 Australian companies, listed companies, down to about 40, as I said. And then we do some really detailed work on the pitfalls. So we're looking at businesses that are still, and avoiding businesses that are growing through debt. And so these numbers are fairly easy to get from a balance sheet, and certainly your broker, if you're using one, can give you some of these numbers in terms of their ratios. And obviously interest cover, we're looking for 4 times interest cover as the minimum. We're looking for businesses to exclude that have grown by acquisition, so the QBE type businesses, unless the acquisitions are very small and very low risk, then we won't own a business that's been growing by acquisition. And also specific sectors. So there are some businesses around that are actually just in very bad sectors where the underlying industry they're in is just too difficult, and they face, instead of structural tailwinds, they face structural headwinds. So Warren Buffett once famously said that when a management with a reputation for brilliance tackles a business with a reputation for bad economics, it is the reputation of the business that remains intact. I love that quote because it really highlights to me that there are just some sectors in the economy that are just too hard to invest in if you want to grow your money over the long term. And as we're going through some of the stock examples, I'll mention some of those today. So I'm going to give you an example now of a business that actually ticks every box, and even though it's not in Australia, will give you a clear idea of what a growth business looks like that's absolutely killing the competition. We don't know a lot about it in Australia as generally because it's not here yet, except through some shopping channels where people can order online, and the business I'm talking about is Amazon. So we have a global growth companies fund and we own Amazon. In fact, it's our largest holding there. And I use it because I think it highlights, firstly, a couple of things that I've talked about already. And that is, firstly, it has an unbelievably strong competitive advantage. And the competitive advantage it has is a compelling customer value proposition. So for those of you who have not used Amazon, Of course you can use it, you can buy through Amazon Australia and get things delivered, but until it really comes here and offers you its Prime service, which guarantees fast delivery, it gives you essentially free music, online music, and it gives you this incredible choice of product at a margin, so at prices well below what other retailers are offering. So it's offering essentially value for money, which is a compelling value proposition. It's offering you choice, which is another thing that people are looking at. So really value for money and choice are two key things in retail that really drive sales, and those two things together make a huge, and of course convenience is the third one. So getting things delivered really quickly, as opposed to taking days and days and days with current logistics systems that we've got here in Australia. Those three things together, convenience, value for money and choice, really line up as a compelling customer value proposition. And I have to say, when we're looking at companies to buy, it's one of the first questions we ask ourselves is, does this company have a compelling customer value proposition? That is it going to drive customers to come back time and time again because it's just too good to go anywhere else? Once you've bought something 15% cheaper on Amazon than you can buy it anywhere else, and it arrives the next day without you having to do anything more than click on it on a computer, you begin to ask why you ever wandered around a shopping centre for hours trying to find it, and then you paid full value for it. On top of that, you can't just have a customer value proposition that's great. You've actually got to make sure it persists over time. And so the two next points I put there, the culture of innovation and the proven quality management, are key points that combine with those filters that I mentioned earlier, the ROE, which in Amazon's case is building very quickly, their sales growth, which is going through the roof, and their debt, which is very low. Really what this is about, this culture of innovation, is very key. So it's platforms, and when I talk about platforms, I mean businesses where there is some way of the customer coming to the business that actually keeps the customer coming back and back time and time again, and attracts, in this new world of online, which is taking off so quickly all around the world, we call it the eyeballs. So eyeballs are drawn to this platform, and people coming back to it because it's got multiple offerings of good quality services that they want to keep buying. And so not only does it have the best features and the depth and the functionality that you want, and it's available online, it's available on an app on a phone, they actually create this platform and combine it with superior data analytics. So what happens is, and I'm sure you've noticed this if you've used online, and especially Amazon, is that if you're looking around for something, sooner or later an ad for what you are looking for will appear somewhere else you are browsing. And that's the data mining ability that these businesses have. They can work out the type of customer you are, they work out what you want, and they start offering it to you. And of course, some people actually say, oh, I hate that these pop-up ads are all following me around. But for an awful lot of people, it says, oh, that's what I was looking for, and now you're offering me an ad for it. That just saves so much time and effort in getting through to buy it. So as each of these platforms grow in size, the value created for each user on the platform increases. So there's a network effect. As more people, more suppliers, for example, more retail type organisations are drawn into the Amazon platform, it actually creates even more choice. And so that's a very important part of this. Let me have a look at, on the next slide, you can see what the price of Amazon's done over the last 10 years. That was a business that a lot of people just didn't understand 10 years ago. They were saying, gee, it doesn't make any money. It just sales for sales sake. But now people are starting to understand the platform benefits and the growth of sales. And the beauty part about this is to go back to my previous point about the growing the addressable market. So while Amazon has a huge proportion of the online market, particularly in the US, over 30% of the online market is captured by Amazon. In total sales terms, they've captured less than 3% of the total retail market. And what we see is an ongoing trend, i.e. a structural tailwind, an ongoing trend of people starting to buy online instead of in the stores. It's just easier to do. You can do it from your own house, and as long as you get the choice, the value for money, and the convenience of getting the product delivered to you very promptly, more people will do it. So I use that example. It's not an Australian stock, but we think when we look at the types of stocks, the type of growth stocks that are available, this probably ticks every box and more. I'll give you a little sub-example. In Amazon 10 years ago, they created a business called AWS, Amazon Web Services. What AWS is, it's cloud, for better word. So companies who are sick and tired of running their own servers and their own IT departments just outsourced that all to AWS, Amazon Web Services, and that business has been growing in recent years at about 55% per annum. So that's a business that was nothing 10 years ago and is now a $14 billion a year business, and we think it can go beyond $100 billion a year business, and in fact much more than that. The total value of cloud services in years to come will be in the trillions. And so that's a business that didn't even exist 10 years ago, and Amazon have become the market leader over Google and Microsoft, who are key players in that area. So, you know, that's what we like about a growth business, that actually can take an idea and over 10 years build it to a substantial business. So it's got the track record, you know, we're not just basing it on 1 year. And of course, what these businesses have, given that they've got all this talent being drawn into them, they've got loads of capital now, they've got lots of sales, their profitability is growing really quickly, they're becoming dominant in their market, is that they have optionality. And that's what we like about quality growth businesses, is that they have optionality. So they have options to start new businesses. So whether it's looking at driverless cars or drone deliveries or all these things, they can allocate part of their business to just see if that will work and kill it quickly if it doesn't, and then start something else. And that ability is heavily restricted to smaller businesses that don't have the benefits of the whole platform. So let's have a look in Australia, because I'm sure you'll be interested in what we can actually do in Australia. So here are 3 stocks. They're in our portfolio. They are quite large holdings in our portfolio. We only have 20 stocks in our portfolio, so we run a concentrated portfolio. REA, realestate.com.au, and you're going to see some of the same statements I made about Amazon being used here locally. So REA, for those who don't know it well, is the online property portal. 85% of people looking for a property online these days go online, and the vast majority of them go to REA first and perhaps Domain second, but REA are the clear market leaders in time on site and in listings of properties. And once again, the key proposition it makes to its customers is convenience, price and choice. And it's cheap as a vendor to list your house on REA compared to print. So, you know, a local newspaper or even a major newspaper, it's a fraction of the cost to actually list it through REA, and that's where all the eyeballs are going anyway. So why would you pay for something where people aren't looking? You want to, if you're advertising, you want to go for where people are looking. There's that network effect, which I talked about earlier. That is, if all the people who are selling something go to a particular site, i.e. REA, and all the buyers are going to somewhere where all the properties are, then you have effectively a stock exchange. And stock exchanges are very powerful. Think of the ASX out here and the difficulty that competitors have had trying to move in and take some of the business of the ASX here in Australia. Once you get all the buyers and sellers congregating in a particular point, you've got to come up with a substantially and materially better offering at a lower price to capture those eyeballs, in this case, away. And REA just stays ahead of that curve all the time by keeping up the quality of its products. They are doing some global expansion. They have small holding in Move, which is the #2 in the United States in property portals, but really the jewel in their crown is the Australian business. And the reason for that is that the Australian market, of all the property portal markets in the world, has one key distinguishing factor that others don't have, and that is that the vendor of the property pays for the advertising rather than the agent. So in terms of the price, let's round it to $2,000, you're comparing the price of REA's product of $2,000 to the average price of a house, call it $1 million, whereas in other markets of the world, the agent, the real estate agent, is paying that commission out of his, he's paying the property portal out of his commission, and so his commission might be $20,000 and he's paying $2,000 out of the price of that. So you can see that the relative cost is very much lower, and that gives REA a substantial advantage. So over the time we've owned that business, over the last 10 years, that stock's gone from a couple of dollars a share to currently in the 60s. And so that's been a terrific investment over time, and it's certainly passed the test of time. It's continued to be able to increase its earnings per share growth as a result of increased uptake, increased prices gently over time, but also raising the quality of the offering that they've given to real estate agents and to vendors. So doing it, for those who've seen eBay, they have a depth type process where you can pay a bit more and take your listing to the top of the listing or the top of the suburb, and agents have been marketing to their vendors that it's worthwhile being at the top of the listing, and so that's how they've increased their revenue, by lifting the number of people who are taking the premium services. And when I think about this stock, I look at that share price and how strong it's been, and their earnings growth, which has been still quite strong over recent years. And then I think about how dire it is in the property market for a real estate portal at the moment. So they are doing really good numbers in spite of the fact that listings, remember, auction clearances in Sydney and Melbourne are now hovering well around 80%, and that means that most vendors are listing their property for 4 to 6 weeks, and that's it. And that's as bad as it's ever been for REA Group. If those auction clearances started to fall, which I'd say there's a very good chance that that will happen at some stage in the future, then people will be forced to relist their property for an extra 4 or 6 weeks, depending on which package they've taken, and that essentially doubles the revenue for REA Group. Not quite, but it doubles the revenue, and that could kick things up pretty substantially. So good already, but with a structural tailwind behind them, which is we're at the bottom of a cycle, but in spite of the cycle, they're doing really well. The next stock I've got here is actually very much in the news recently. So you'd all be aware that the Fairfax Media has done an expose on Domino's in mid-February, just before their their half-year announcement, and found some cases of the company's franchisees not paying their staff the proper salary. And I won't go into all the detail there. You could go back and have a look at that. But so the issue there is what is the value proposition for the customers of Domino's? And once again, it's cheap pizzas, $5 pizzas. It's delivery in 20 minutes or so, becoming shorter. They're putting in ovens now that can cook a pizza in 3 minutes and have it delivered in 10 minutes. And choice, they're adding items to their menu. I'm not really going to go into whether Domino's pizza is great to eat. The reality is it's a treat food. It's something that people choose as a treat, and it's a great treat for pretty low price for Australians who might be struggling with their budgets in other areas. I mean, a $5 pizza to feed a family is pretty good, and if you buy 2 of them, $10 is an amazing amount of food for the money. And really Domino's are focused on delivering a superior customer experience, and that is deliver that food hot, good and quickly, and they're doing everything they can to make that happen. And they're doing that through innovation. They're making sure that their drivers take the fastest route there by putting a driver tracker in. Obviously the other benefit is that if you've got the app, you've ordered online with a couple of clicks, you paid your money, and then you can see the driver coming towards you on a map. There's no doubt about whether you're actually going to get your pizza on time, because you can actually see the driver on the map coming towards you. I mean, this all comes together as a package of customer value that appeals to customers. Now, obviously, we're doing work on the other side to make sure that this is a sustainable model, and that underpayment of staff members is not something that's endemic. So we're obviously very keen to make sure. We've done years of work. We've owned this company for years, and so we're confident that that's the case. But obviously, you'd be mad not to read the newspaper, see an article, and then assume that there was absolutely no issue at all. You'd have to look into that. And even Domino's itself has instigated a full audit of its whole network of all 700 and something, I forget the exact number, 720, 730 franchises in Australia, to make sure that they're all following the rules. In any case, the reason I bring up Domino's is it is a major holding, and in spite of the fact that they've had a bit of a reversal in the last couple of months, largely as a result of a worry about whether this was like a sustainable business model. We've owned them since very early days when the price was a couple of dollars a share, and there's a business that in the last half increased its earnings yet again by 35%, and a lot of the growth in that business is going to come from Europe, where they've got roughly the same number of franchises, but referring back to my previous comment about increasing the addressable market. So the European market, where they have businesses in France, Benelux and Germany, is 6 times, that market is 6 times larger than Australia. So the opportunity to roll out stores over there and deliver great Australian pizza to the Europeans is really good. And of course, a lot of people often say to me at this point, gee, the French don't really eat pizza, do they? Well, they're actually one of the most profitable fast food markets in the world. And they are, I think, 2nd or 3rd from memory in pizza eating in the world, obviously after the US. But they're a very profitable fast food market. Not everybody in France eats gourmet food. In fact, a lot of them eat pizza. So with that, I might move on to our last company that we're going to talk about today, and that is Seek. So this is another online business, and I guess it doesn't take much to draw a line between these three and see the connection. So in spite of the fact that Domino's is a food company, it's really a technology company. It's about using technology to deliver a customer value proposition. REA, which is clearly an online type business that's earning real money and real profits, and Seek, with its jobs board and placement strategy, also is an online business, and once again it harvests the network effect, which I talked about earlier. That is, if all the job seekers are looking in one place, then the employers would be mad not to go to that place, and vice versa. When all the employers are looking in an area, all the job seekers would be mad not to go. And that network effect creates a virtuous circle that others have tried to break into, and notably businesses like Indeed and LinkedIn, and when we look at the numbers, frankly, Seek has just managed to pair them off every time. They're improving their product, they're improving their database, they're making the product more attractive to employers and placement agents who use Seek to find the job seekers, and so really they're improving the customer experience. And what that does is gives them a very deep understanding of each of the users. So clearly they're doing a lot of work to make sure the major employers are looked after, but as job seekers put more of their detail into their profile, clearly Seek gains a very deep understanding of each of those job applicants and what they're looking for, and it makes it easier for them to match them up with the right employer. And the success of that can be seen in the price over the years. I mean, we bought that stock in $3 and here it is today in $16, and it's delivered terrific earnings growth over long periods of time. So that actually is, I've gone through now all of the stocks I was going to do, but I think there's a nice opportunity here for some Q&A, and so there might be a small pause while I read each question because I'm not that fast at reading. Here we go. Okay, so what has been the historical total returns of this growth fund, please? Oh, I see. Yeah. So, the Australian Growth Fund. So, we took over the fund itself in 2002, and so I'm going to have to just draw on my memory here. So we've done about 3% better than market, and I think from memory the market's done about 9, so we've done about 12. I'll be happy to be wrong on that. Obviously, don't carry every item in my head in terms of the performance, but over every period. But roughly, we've over the last 2002 to about today, it's done 3 to 3.5% better after fees than the market. We get the ideas about Amazon, but do you have any Australian growth stocks that you can speak so long about? Okay, well, yes, I think you might have put that in before I started talking about the Australian growth stocks. So yes, I think we've covered that one. REA has been doing well, coupled with the property boom, but how will it do if there's a crash and a slowdown? So yes, so a lot of people think it's because of the boom that they've done so well, but as I might have explained a little earlier, and maybe not clear enough, is that the boom has actually been negative for REA because they make their money about time on site. So if properties go up and sell quickly, then REA doesn't make as much. If the property cycle were to turn and property started taking, I mean, I remember when I was much younger, you know, my parents took sometimes 3 or 4 months to sell a property. We would go back to that time where people had to do much longer periods of advertising and open for inspections over, you know, months rather than just a few weeks. And REA's revenue would generally increase over that period. Are you concerned that REA may be vulnerable for the government's policy intervention in the name of housing affordability? Well, I mean, the reality is the government is desperately trying to make housing more affordable, and that would increase the turnover, make it available for younger people and people able to buy housing. I think it just comes back is that would be a good thing, as it would get more houses on the market. Like, I have my own personal opinions on how that could be done. The reality is that I think it's a supply and demand issue. There's just not enough supply of housing. If there were more supply of housing, there'd clearly be prices would be lower and people would be able to get into the market. This is a very vexed problem for government because they don't want to create a price crash. I think REA is in a very good position no matter what, because you do need advertising. No matter what happens to housing, you need somebody in the middle providing a platform for housing. Is Domino's now overpriced given its strong growth? So, look, that's a great question. It's only 6 months ago, and I need to get technical for a moment in terms of its valuation. So I apologise. I don't like throwing around items like price-earnings ratios. But the reality is that on a forward basis, it's only 6 months ago that Domino's was trading on 60 times forward earnings. Today it's trading on around 30 times, so it's come back a long way. I mean, the stock was at $80, and I don't track it every day, but it's at about $60 today. That's a great and obviously in the meantime earnings have gone up substantially, so that's why you can't just take 80 and 60 and turn 60 into 30, if you know what I mean. But the bottom line is that its earnings are going up and its prices come down. So actually, in a valuation sense, because we think of this in a long term, not just 1 year out, so that's the danger of just looking at things and saying yes, one year out, because you're not buying for 1 year, you're buying for 5 years or 10 years or even longer. And so in a long-term sense, we think the valuation is pretty compelling at current prices. Do you think Bega is a good company at the moment, given it owns more of the supply chain for mill products into China? Look, we don't own Bega, and I have to say that the whole we've always wanted to stay away from businesses that either produce some sort of animal product, or like it's either a fish product or something that grows good for hooves. There's some real challenges in primary producing and producing for markets like that. So why we own Blackmores and not Bega and Bellamy's and all these others is largely the difference between a product that has a very long shelf life, like vitamins have incredibly long shelf lives. And so when you get a regulation issue like has affected Blackmores, and a lot of the agents that were selling into China destock, so they stopped buying from Blackmores, all of that product that's been produced on the shelf is actually still good for another couple of years. Whereas if you've got primary produce, even if it's powdered, and the reality is they have reasonably low time limits on them, and so it's much more of a challenge with a regulated market or potentially regulated market to get confidence in the long-term growth of those businesses. And the other thing is, once again, I go back to 80-year track record versus a much smaller track record. Hi Tim, I really like using ROE myself as a great marker for growth. Are you able to explain whether or not Hyperion thinks of this in terms of book value or market value based on market cap? Yeah, so we're looking at the amount of real equity in the business. Look, it's a little more complicated than that, because we're looking at obviously returns on capital, and rather than get into a technical discussion, because I know most of the audience here is not technical, perhaps I could put it another way. We like really capital light businesses. We like businesses that don't require a lot of capital to get going. We don't like businesses that have big mines and big factories that need repairing and updating and spending money on all the time. We like businesses that actually have very little capital invested and actually, as a result, earn really high returns on equity. I'm going to have to rush here. We've got exactly 2 minutes. Domino's is growing by acquisition. Yes, John, it is growing by acquisition. It's bought into France and Germany, but they're exactly like they're pizza businesses. So they're very similar, and frankly, we've been very careful not to overestimate the future of those until they've actually fully combined those businesses in. So when a business normally makes an acquisition, a bolt-on acquisition, we ask ourselves, how much different is it to what they're currently doing? And so buying pizza shops, it's really good. Often we take into account the level of cultural similarity between the businesses. And so that's a challenge, of course, for us in France and Germany, where they bought a different chain and included it. So we downweight our holdings during those periods. We'd prefer not to hold businesses to get involved in big acquisitions. And without going, given I've got a time limit, there is a challenge in coming up with the percentage that we cut off, but we do actually have a percentage that we cut off. Some of those, I don't think I can answer. The last 3 questions I can't possibly answer in 45 seconds. There's just too much in there. Look, we've gone to the hour, and I think we're going to get cut off at an hour. So I thank you all for attending today. It's been absolutely terrific. I've enjoyed your questions, and I hope I get an opportunity to talk to you again at some stage in the future.
Yeah, we can maybe follow up the questions.
Yes, I'd be happy to follow up the questions separately. Yes, of course.
That's great. Thanks, Tim, for your presentation today and for taking the time to answer so many questions. And thanks for everybody who dialed in today and put forward the questions. And we hope that you'll dial in for our next webinar.
Thank you.